Welcome back to Sashimi. In this episode, I interviewed Vlad Besprozvany, the founder of Nexa Equity, a private equity firm investing in lower middle market software companies. Nexa was formed this year by Vlad and Insight Partners alumni and has already made several acquisitions. We spoke about the competition in this space, Nexa's deal sourcing, due diligence process, deal structures, and exit strategies. Vlad then walked me through the acquisition of AutoReturn, whose software connects law enforcement and towing companies. The international expansion strategy blew my mind away, so you better listen through the end. Vlad, thanks very much for being on the podcast.
Yeah, thanks for having me. I've been looking forward to this.
Well, obviously going to be talking about Nexa and private equity in SaaS in general. But before we start, maybe you can say a few words about yourself and Nexa Equity.
Yeah, absolutely. So we are a lower middle market software investor, mostly focusing on control investments within the smaller scale of companies, 5 to 20 million of revenue. And we really take a growth-oriented approach as we think about the companies that we partner with. Really, not only are they themselves growing, but we're really focused on helping expand their top line, their bottom line, as we think about partnerships with founders and management teams. And we really try to walk kind of a fine line between being hands-on and very active and helpful within our portfolio companies, but also really respecting their overall vision of what they want to build and really making sure that we are really kind of proactive in terms of helping them achieve that target in a hopefully shorter time period, whether it's through organic growth or through M&A.
And what's your background? How did you end up starting a fund?
Yeah, absolutely. So I started my career in investment banking, worked at Citigroup and then JP Morgan, and never thought I'd end up as an investor when I was growing up. Didn't really know, the field existed. I was raised by engineers and computer scientists and really was just kind of drawn specifically to the software market and wanting to be involved with companies throughout their entire life cycle. Had a chance to join Thoma, one of the larger private equity firms focusing on software, and was a phenomenal opportunity to work with some of the best operationally minded investors, in my opinion, out there. We really were taking hands-on approaches with our companies and really trying to help them operate better and think through the product categories they were in, their go-to-markets, using a lot of data and analytics to be able to make better decision-making. And after a handful of years, had Insight Venture Partners, now Insight Partners, Devin Perek, reached out and had an opportunity to join their team and firm out in New York and really help build out their control investing and buyout strategy. Their DNA was originally in venture capital. They then extended to growth equity and really wanted to make more of a presence and have more of a foothold within their control investing strategy. So came over and really spent a lot of time on the application software side of control investing, and then on fintech doing a lot of the minority and majority investments.
They dropped ventures from the name because of you guys started doing control investments, huh?
I think, the fund size got so large that it was tough to deploy the billions of dollars with just a venture strategy. But yeah, so that was great. And then after that, spent a handful of years working at a family office and a private equity fund really focused on consolidations called Greater Sum Ventures, where I'd known Ross Crawley for a number of years, who was an operator at one of the companies that I had worked with when I was at Insight, came over and we were very active in really consolidating several sectors in the application software space and the fintech space, and really launched Nexa earlier this year because I saw that there was really a gap forming at the lower end of the market. A lot of the funds that had been successful in the category had really scaled and grown in terms of fund size. And it wasn't just the really large funds like Thoma and Insight Partners, but it was really all of who I even thought of as lower middle market specialists. Their success led to larger vehicles and in turn, really them focusing on companies that were themselves larger in scale. So at that point, really felt like there was an opportunity to go and launch a fund really focused on partnering with founders and management teams to kind of help them, what we call kind of the scale up size of their organization, right? So as they're going from that high single digit, low double digit revenue size to the 30, 40, 50 million of revenue, there's a lot of building that happens. There's a lot of, opportunities. And oftentimes what we see is founders, will have a really good understanding about their product, their end market, but they won't necessarily have all the tools and skill sets that especially Silicon Valley or New York-based firms will have access to. So they really kind of want that help as they think about really leaning in on the opportunities they have, whether it's hiring additional talent, putting in place metrics and systems, and thinking through how they should really be operating, as well as, M&A is really something that companies are thinking of much earlier in their life cycle. But for the most part, founders just forget about the capital, the know-how or the expertise to be able to do a transaction from start to close. So we end up really, partnering with management teams to be able to do that. So myself, along with a team of other ex-Insight investors, partnered up and really launched Nexa earlier in the year. And we've since, had a lot of growth and success, and it's been really fun.
How crowded is this space or lower middle market?
Yeah. So, I'd say the category that we're going after, this size and scale of business, especially companies that were a lot of our focus areas, companies that are not only growing, 25 to 75%, but are break even or profitable and founder owned, that category was really very hotly pursued, I'd say, and quite crowded and competitive in terms of the investor market 5-7 years ago. But again, given the fact that a lot of these firms had a lot of success with their investments, they've really moved up market. So really, it's kind of left a vacated space. We see a handful of groups that are targeting this area, but for the most part, our biggest competitor to an extent is the lack of a decision, right? Status quo, where the management team or the founder decide to not transact. So rather than going up against other competitive investors, we're really kind of having them think through that. Or alternatively, minority investors. But for the most part, what we found is the minority investors are writing a larger number of checks and have more portfolio companies in their funds. So therefore, in terms of the time and attention that they're able to dedicate, it's a little bit less than groups like us who have 7 to 9 investments out of our fund, where we can really have a great ratio of our time or our operating partners to the portfolio companies.
You kind of touched on some metrics you look at, but can you provide like bullet points? What's your investment criteria for your companies are?
I'd say there's a broad suite of them that we kind of evaluate. As I'm sure a lot of people have said, it's more of an art than an exact science as to how you come up with a valuation and how you stack rank your pipeline. But for the most part, I think we really prioritize the growth of a company, an efficient P&L, and making sure that their gross margins are efficient, as well as they're not burning a large amount of capital. We're not big investors in companies that are burning, but instead want to find efficient businesses where we can lean in and really kind of run them efficiently at either break even, optimizing for revenue, or optimizing for EBITDA, and really kind of run them in a profitable standpoint. So I'd say we're focused on a lot of the efficiency metrics within, what is their payback period for a new sale? How do we think about bookings momentum? I think we're, like a lot of the industry, extremely focused on high retention businesses, gross booking retention, net booking retention, as well as logo. That has massive implications, not just during our ownership period, but as a company gets larger, I always think of retention as a leaky bucket. If you're losing 20% of that bucket, when the bucket is small, it's easier to refill it. But as that bucket gets larger and larger, it becomes more and more difficult. And eventually you're spending all your time refilling the bucket rather than adding more to it. So we spend a lot of time around customer analytics, and we kind of have, our set of certain requests that we ask for a company before we really look to put an offer forward. And the customer file is probably one of the more important ones, if not the most important one for us. It allows us to draw a lot of conclusions around customer behavior, upsell behavior, downsell behavior. We segment customers different ways. And oftentimes when we're doing diligence on a company, we'll present our findings, and the management team may have fundamentally or qualitatively had intuitions on some things, but we're able to point out certain areas where we say, hey, if you look at this subsegment of your customers, they actually are growing faster or, have stronger usage and retention. And they're able to reposition their go-to-market, their product strategy to really target these customers, which are much more valuable. So that really is an incredibly important metric for us. I think another one that we're focused on is alignment with management. So making sure that management is not only continuing forward from an operational standpoint, but they continue to be meaningful owners of the business. So we're typically acquiring somewhere between 55 and 80% of a business. And really that remaining piece is management and founder rollover. So we want to make sure that economically they're aligned with us and incentivized, and it works as a really nice lever actually from a value perspective, where oftentimes the companies that we're able to partner with, the CEOs have the potential to make a significantly larger absolute dollar return when we go to mutually exit the business to whoever the next buyer is, rather than when they even took the initial funding from us. So I think that rollover percentage and that alignment with management is important. And I'd say lastly, we're looking for, I think, strong teams. It's not necessarily a metric that you kind of track, but really kind of one where we feel like there is a shared vision and kind of a true North Star as to what we think the vision should be for the company, to make sure that once we get into the ownership period, we're all running full steam ahead. So potentially not a metric. And then we look at a lot around market positioning, again, probably more qualitative assessments, but things that we really look at are, how fragmented is the market? How big is the TAM? Oftentimes we're spending time in markets that are sub $1 billion in TAM, partially because at the bite size that we're writing equity investments, we're able to really, make a acquisition or an investment or partnership with the leading company or provider in that space, rather than going and backing a company that is in a highly competitive market and maybe lacks that differentiation. And additionally, it also protects us to an extent from having a large venture capital firm be able to come in and invest, $100, $200 million in sales and marketing or product development, be able to kind of overnight create a market leader. We can come in and we feel like we have a good amount of room to grow within that market size. And a lot of what we do during our ownership period is also, we're really looking to expand that company's TAM, whether through organic product expansion or through M&A, as we look at the ancillary markets.
And when it comes to revenue size of the typical companies you look at?
Yeah, so our sweet spot is really, 5 to 20 million of revenue at entry. And by the time we look to exit the businesses, they've typically grown to 30, 40, 50 million of revenue. And the nice thing is, at least what we've seen is, while there's been a meaningful uptick in valuations in the last, obviously, 5 years, but even more recently, kind of from pre-COVID to post-COVID, I think the software business model has been incredibly resilient to a large extent. The public markets and even the private markets have really seen the value. That has had a much less of a trickle-down effect and impact at the area where we're investing. So we're oftentimes able to get really attractive valuation multiples for companies at that size and scale, whereas the market becomes much more competitive as you look at companies that are north of 20 million in revenue, and people are paying significantly higher prices and multiples. So part of the reason we look to invest in that space is they're more attractive entry multiples and return curves as we think about our hold period.
Can you quantify the attractive multiple?
It probably depends, again, in a large way on the end market. But, what we're typically seeing is kind of mid-single digits in terms of revenue multiples, and low teens, mid-teens in terms of EBITDA multiples. And as we think about it, that's kind of either on a run rate basis or a couple of months forward. But those are the typical valuations we see.
Is it common for the companies of this size having EBITDAs?
It's surprisingly, yeah. I'd say a lot of these companies have very good profitability. About half the companies that we're investing in, have a healthy EBITDA margins, 20, 30, 40%. And if you think about it, it actually makes sense from the perspective of, these are bootstrap companies that are run by the founders, and they haven't raised large amounts of capital, if any capital, externally. So the way that they really kind of are able to de-risk or compensate themselves for the years that they've been building is to have these profitable businesses. Oftentimes, they're not thinking about, though, how do I reinvest that either back into sales and marketing and kind of run a break-even business that can grow faster, or alternatively, how do I reinvest it into M&A and kind of accelerate my inorganic growth?
How do you source these deals? All these companies are private, and it's pretty hard to find information on their revenue and everything else.
I think a lot of that is the Insight Partners DNA. It's really being able to think about proactively identifying end markets, having strong theses, and then making sure that we have the team members that are really kind of focused on it. So similar to Insight, but obviously at a much smaller level, we have associates that are really in the weeds. We're talking with them at a firm-wide level. And at any point, we have somewhere between 10 and 15 subcategories and subsectors that we're really bullish on, right? And we're not talking government tech as a category. We kind of we'll double click and we'll say within government tech, there's transportation technology for cities, counties, and municipalities. And, our second deal, for instance, is within the towing space. So we'll kind of double click, triple click into a category, and we'll really map the sector. We'll identify who are the 50, 100 players in the space. And then we'll basically try to narrow that list down to 10 or 15 names that we really think are highly attractive. So we'll exclude companies that are either too large, too small, have raised too much money, are in a product category that we don't think is a attractive starting point. Oftentimes we look for the system of record. So we're really trying to hone down, narrow it down to 10, 15 companies, and then we'll make an active path to try to get through to those companies. And whether that's through our network, our contacts in the industry, other CEOs that we leverage often that we've backed before that will introduce us, or just really by having targeted outreach, whether that's emails or calls or creative ways like postcards and letters, we try to get through these CEOs and we try to show an understanding of their end market, and it's very tailored in the way that we're trying to engage with them because we've built a thesis around that sector and we try to articulate why we believe their company is a winning company and how we believe that we could really add value beyond just the capital. And we have a pretty good success rate in terms of getting engagement with them and making sure that, we kind of are moving along the process.
What percentage of companies you would say are actively trying to sell themselves versus you reaching out to them and they kind of starting thinking about sale?
For scale companies, I think of companies that I worked with when I was at Thoma Bravo or Insight Partners. The mindset is always kind of everything is for sale for the right price. If a strategic or a sponsor comes knocking and is able to pay you a price that hits your return or your threshold or you think is an attractive value, everything is kind of open now. There's always kind of a cat and mouse dance as to who blinks first, but I think that's very much the approach of everything is more or less for sale, right? When you look at these smaller companies, a much smaller percentage. So I would say at any given point, single digit percentages of these companies are actively looking for someone. But the reality is they may be needing something which isn't a sale, which is operational help that we're able to provide that then catalyzes the sale. So if you think of what we offer beyond the capital is, hey, we'll help you hire talent, which you otherwise may have been struggling to hire a CMO or a CRO. We'll help you think through the metrics that you should be tracking. A lot of these founders maybe they know what retention is, but they don't know why it matters, or they're not analyzing it in the same way. They don't think about sales reps and quota. And a lot of them even have awareness of, hey, here are the things that I'm really good at, but there's a handful of things that I really could be doing better. And I think more and more founders and companies are starting to realize that the capital is not the differentiator. It's the partner and their skill set and what can they do after the investment. Commercial introductions, acceleration. How can they be that extension of the organization? So I think by demonstrating that, you're able to catalyze the conversation of, hey, let's start talking about what you're going to do on the capital front. And a lot of founders don't also necessarily think initially of a control investment, right? I think if you think of the traditional mindset of an owner, they'll think, hey, why don't I just raise a VC round or a small round? I think, first of all, a lot of the companies that we're targeting are just not growing fast enough for the VCs to really get super excited. For the most part, venture capital funds are chasing companies that are growing triple digit, 100, 200, 300% year over year. Whereas our companies are growing closer to 25 to 75%. So good growth, but they're kind of out of that target. But even if they were to say, get a minority investor, at a sizable amount, the controls, and I always think of it as like a car, right? If you are selling 10% of your business, maybe the investor is willing to kind of sit more in the back seat and let you, the founder, drive the car. Once you start selling 30, 40%, the investor is going to kind of sit in the passenger seat and have a hand on the wheel, right? And then really at that point, the question is there really much difference between that and having the investor have their own wheel, right? Where you have a steering wheel and they have a steering wheel. The kind of analogy can be taken a little bit further of if you find a partner that's going to be really hands-on, it's not going to matter, whether they have a second steering wheel or not, as long as they're, again, really kind of value additive. So I think it's something it's a relationship that has to be built. They're handing over, the most valuable asset, kind of a baby to an extent that they've been building. And they really have to believe that, your vision aligns with theirs.
So when you end up in a situation where you actually compete for the deal with another sponsor, how do you guys differentiate yourself? How do you guys win these deals?
For the most part, we've been really fortunate in that most of our early investments have been one-on-one conversations, right? We have a view on the market. We have a relationship with a CEO and a management team, or we have a view on the market. We identify the company and we kind of have a one-to-one conversation. But there have been cases where we come up against other groups. One comes up in particular where we were up against two very reputable blue chip investment firms that were really kind of playing down market, which is rare, but does happen. I think given the quality of the asset and the opportunity set, and I think the way that we were able to differentiate, even though we were a firm that was less than a year old at that point, was, again, I think we had a really good understanding of the market. So we were able to articulate that. And B, I think we were able to explain what was kind of the value of working with us and our thesis and view after the investment, what we would do proactively to help the company grow organically and inorganically. We laid out, I think, what I would imagine they would say would be a pretty thoughtful case around organic expansion, where we saw opportunities within the business, as well as on the M&A side, where we saw ancillary markets that we could really kind of expand their TAM and be able to accelerate their growth. And I think that's what differentiated us beyond these other two groups who maybe had longer track records, were more reputable, had larger funds. But I think we were able to articulate that. And there's also some benefits in being a younger firm in that, we don't have a portfolio that's 50 to 100 companies. But on the flip side, that also means that the time and attention that we can spend on each company is disproportionately large. So I think that was definitely another reason that factored into that decision on their end.
When you guys come to the agreement, how do you typically structure your deals? I mean, you mentioned that you get 55 to 80% ownership, rest is a rollover. How much debt do you put in? Is there any seller note, anything like that?
Yeah. And this, again, it really is case dependent a lot of times on how we think about the valuation. What is the seller solving for? We'll structure it in lots of ways. It feels like more and more these days, earnouts are components of valuation, and we're able to get sellers to really bet on themselves and say, hey, we believe the business is worth this today, but if they hit these growth targets that we have mutual discussions, they unlock another tranche of proceeds to themselves, or either cash compensation or stock that's issued to them. So I'd say that's a meaningful component. Seller notes are another way to solve it, right? Deferred compensation. And we definitely do consider debt. I'd say we typically about 50% of the time will look to put debt on a business, and the other 50% we will wait, and maybe we'll use debt as we think about M&A, and we'll try to limit the equity investment necessary for the future add-on acquisitions that we do, or we believe we're more conservative in terms of the quantum. So we're typically putting somewhere between 1 to 2 times revenue or ARR of debt on the business, or alternatively kind of sub 6 times or sub 5 times EBITDA. Especially, smaller companies, I think you want to be careful in terms of making sure you preserve the ability to invest in these initiatives and not have a large amount of cash flow being taken up to service the debt. But it feels like lenders these days are more and more understanding the market. And I think software specifically it's a market that I think is similar from subscale to really scale, right? So if you think of the challenges and problems that a company that has 500 million of revenue to a company that has 50 million of revenue, and even extrapolating down to a company that has 10 million of revenue, they look and feel kind of the same. Their P&Ls are structured similarly. Product development, their sales, pain points and opportunities are the same. So I think lenders are more and more seeing the opportunity to play down market, even in the 5 to 15 million revenue range, and are wanting to align themselves with great management teams and great investors to be able to get their foot in the door as that company grows.
And when it comes to these lenders, are we talking about banks or debt funds?
Yeah, it's a mix. We have relationships with both groups. I think, again, it's really case specific as to who has expertise in that end market and that category is able to really scale with the business.
Can you walk me through the entire due diligence process? How long it takes and what are you guys particularly focused on?
Yeah, absolutely. So the beauty of our firm is not only do we have a lot of the insight DNA, but we've added other investment professionals along the way. One of our team members at the senior level comes from Luminate. We have another one that's joining us from another firm in LA, Arrowroot. So I think we're able to really kind of think about the best practices and make sure that we really have a thoughtful and very specific diligence approach that is also not overly cumbersome for management teams. So rather than just going through and checking a bunch of boxes, we really kind of identify out of the gate, what are the data points and pieces that we really need to understand, and what are the things that, it would be nice. The reality of investing in this end market, or rather this scale of company, is that they oftentimes won't have all the data that you would necessarily want readily available. And it's not because for any other reason that they just haven't thought of tracking it. So we're oftentimes jumping in and getting raw data files and helping management really kind of sort through and pull out analytics and information out of their business. I'd say our typical diligence period is anywhere from 30 days to 45 days. And in that time, we're able to kind of cover everything from in-depth financial diligence, business diligence, market analytics. We're working with third-party accounting firms. We're working with third-party tech diligence firms that are going through the architecture, the security of the business. If it's a healthcare IT asset, we're thinking about the HIPAA compliance and really bringing on third parties to help manage that. And additionally, we're really kind of working closely with our legal partners to analyze contracts, potential exposures, making sure insurance is really kind of buttoned up in the organization. And what is a very in-depth process oftentimes brings opportunities to light. So we'll talk with our management team very actively throughout the diligence process, having daily catch-ups with them. And look, it is a more in-depth review of their business than they typically are doing. But what the vast majority of them say coming out of it is, they say, hey, not only were you guys giving us opportunities, but as you were doing the diligence, we were realizing things about our own business, things that we can improve, the questions that were asked, the things that it made us kind of analyze and go through our business. We realized, hey, we should really button up this aspect of the business up. We have this pricing opportunity. We have this customer opportunity. So they really come out of it, I think, even before we start with our operational strategy during our hold period. They already start with really good insights as to ways that they can improve the business. But we do try to take a balanced approach of making sure we analyze every piece of the diligence and be extremely thorough, but also not overwhelm the management teams with requests that are unnecessary.
How often does this due diligence process lead you to the decision to pass on the investment?
It's a good amount. We try to do a lot of that discovery period before we really get into exclusivity. And I always think about diligence as being twofold, right? There's the work you do before you get into exclusivity with a business, and the work you do that is after exclusivity. And I always think of your work after exclusivity as really needing to be more confirmatory on the business diligence. Obviously, you're going through, you're making sure that the company owns their product and there's no legal red flags, or their accounting systems are all good. But we really try to cross a lot of those potential deal killer questions, I'll call them. We try to address them ahead of getting into exclusivity. And I think that's important because you really want to make sure that you're really following through on your commitment to the management team. And that's where, look, we analyze hundreds of businesses over the past 9 months, and the vast majority of them we don't invest in. We've closed 2 investments. We have 2 other companies that we're in the process of investing in, but on the sideline is, hundreds and hundreds of companies that we decided not to lean in. So I'd say the vast majority of companies you decide for one reason or another. Sometimes it's how far along they are on the product cycle. Oftentimes it's the competitive dynamics of the market they're in. Sometimes it's a good business, but it's 12 months, 24 months earlier than we really have conviction that they are kind of the clear market leader in a category, or, something around their financial profile that we figure out is not interesting. And another thing that's important is obviously valuation. Not something you asked, but a lot of the businesses that we end up passing on is because the valuations are higher than we feel comfortable paying. We want to make sure that we have strong returns for our investors and our limited partners. So I think we want to be really, really thoughtful around the prices that we're paying for these businesses. So that's also a pretty meaningful reason why we don't end up going all the way to the finish line.
You mentioned that you guys made 2 acquisitions, and I believe one of them is AutoReturn. Can you walk me through the whole process, like from sourcing to investment thesis, etc.?
Yeah, absolutely. So really interesting story. I'd had a good amount of experience in the GovTech space, having worked with 3 companies that played in that space, including one business that I backed at Insight called Pay It, and, really thought that it was a really attractive market that had a lack of technology adoption, right? So there are certain categories and end markets that just are years, if not decades, behind the curve. And the government space is definitely one of them. So had always, liked the transportation aspect of it, and had really specifically liked the towing piece of it. Really a big problem as cities think about managing their towing fleets. And right around the time that we were, spending a lot of time in the category, one of the CEOs that I'd worked with in the past, actually met another CEO, John Wicker, at a conference, and they were kind of talking to each other, founder to founder. And John Wicker was saying, hey, listen, kind of thinking it may be time to kind of bring on an institutional investor. I'm having lots of groups reach out to me and ping me. And the CEO that I'd worked before say, listen, why don't you talk to my buddy Vlad and see where it takes you? Maybe he'll give you some advice, who knows? And John and I connected, and I immediately knew that, hey, this is exactly the company that we've kind of been chasing in this category and sector. So there was no banker, no formal process, but 2 other groups that they were talking to. And I think we were able to really, as I mentioned earlier, really be able to explain what our vision and strategy was for that business, and be able to kind of position ourselves, as the preeminent partner for them, regardless of kind of the valuation that we were at. So I think that was a really exciting business. And we've since closed on the investment, about a month and a half ago. And we've made a lot of progress, really kind of helping them scale their sales organization. We're evaluating a couple really strategic M&A acquisitions that will kind of expand our reach and breadth. And additionally, we're really kind of helping them think through down market product and how they can really, again, expand internationally. They are the leading provider of towing solutions for cities and municipalities. So if you think of the way that, cities before using AutoReturn would have solved their towing problem, you'd have a police officer or a parking enforcement official by the side of the road. Let's say someone's parked next to a fire hydrant, or there's been an accident on the side of a highway and they have to initiate a tow. They would call 911 dispatch, the same people that pick up the line and say, hey, what's your emergency? They would call them. Those people would in turn look at a literal sheet of paper that sometimes would be pinned up in their cubicle, look at the 10 to 20 towing operators that operate within the city, narrow down to the handful that work in that part of town, call them manually, a handful of them manually, and then those towing operators call tow truck drivers. You get
I already
the picture.
hate this whole thing.
Yeah, this whole process is very drawn out, right? And what AutoReturn has done is really built the leading solution in the market to be able to automate all of this. So now, in an AutoReturn world, cities have all the tow truck drivers in a city have an app on their phone. Think of an Uber-like solution. Yeah. The solution understands where they are. So when a job is requested by a police officer or someone in the dispatch office, it then automatically routes it to the closest tow truck driver who can pick that up, right? Based on the size of the car that they're picking up and their truck. They get a notification, accept or deny. They show up in the job at the location within 10 minutes instead of within an hour. And on top of it, it's a huge benefit for the city and the constituent, because the city's able to have visibility into what happens to that car after, right? So, and the citizen can also go on to the AutoReturn website and be able to type in their license plate number or their VIN, and it says, hey, your car is located at 2nd and Main, at this lot, and you owe $200, let's say, for the tow. So, they're the clear market leader, 100% customer retention since inception, 90 to 95 market share. They've won 30 of the last 32 RFPs. So really kind of a greenfield space. But I kind of mentioned a lot of the opportunities they were thinking. Up until May, they'd had one sales rep. They had expanded internationally, but funny enough, the reason they expanded internationally was because their founder went and took a vacation to Italy, took a day or 2 off, hired a translator and walked around in Rome with a city hall and convinced them to use the solution. And then from there, they won Naples. So it's just one of these opportunities you think of and you're like, well, yeah, clearly this should be automated. There's no reason that this telephone literal telephone game should happen.
This is crazy. I can't believe that's exist. And so you said it's not a crowded place.
No, so I mean, basically, we're the leader in the space, right? We have 90 to 95% market share. You know, there's a handful of smaller players, but, you know, we really kind of have that leading product. And it's because, you know, they spent years innovating and building this really rich feature set. And we're really excited about, again, helping them take it from where they are now, which is kind of the large blue chip cities like San Francisco, Denver, Philadelphia, Indianapolis, and Baltimore, and really kind of get it to where it's all across the US and it's applicable not just in cities, but states and counties, you know, smaller cities. And even if you extrapolate it to think of, you know, a large apartment building or an airport or a HOA that kind of sees towing as their last step in the parking enforcement, that's something that they would love to have that integrates with their property management tool.
I'm looking at my window. There are 3 cars that I want to tow. I swear to God, they're annoying. And I'm I'm thinking about right now.
We're working on a product that will hopefully, you know, help you in the next, you know, 3 to 6 months.
One thing I can say, just take my money. Like I want to be investor. It does sound fantastic, really. Good luck with that investment. I'm sure it's going to turn out very well.
That's kind of the story I say with a lot of our companies, right? They're in these, we kind of think of sometimes unloved, maybe not the sexiest category, but they're just that indispensable, you know, system of record. We always ask ourselves when we diligence, you know, can you run your business without this tool? And if you can't, you know, that's a product category that we want to be in.
So when you buy in the company, do you automatically think of the exit strategy right away?
Absolutely. Yeah. I touched on this a little bit earlier. When we think about our vision, you know, we're really doing that during the diligence process and try to align with management to make sure that we see it the same way, right? If we have one vision and they have another, that's going to be a potential conflict point multiple times along the way. So we immediately think, you know, are we solving for market share gain, like an AutoReturn? You know, are we solving for just kind of growth and profitability and EBITDA? And we kind of think of it as, you know, the two worlds of, you know, are you optimizing for revenue with a break-even profile, or are you optimizing for EBITDA with, again, good growth, but you're really kind of more focused on unit economics dropping down to the bottom line? And you manage those businesses slightly differently, right? We have a playbook at Nexa that, you know, we'll really kind of put to work, but the decisions you make along the way are different. And it really kind of comes down to, you know, what is the growth rate of the business? Typically, at least in this current market environment, if you're growing above 30%, buyers will typically think about a revenue multiple. And if you're below 20%, typically an EBITDA multiple, and somewhere between 20 and 30% is a gray area. It's not, you know, hard lines, but ballpark how we think about it. But it's also, you know, what is the product category and how competitive is the market? You know, what is the subsector and industry? That helps drive a lot of our decision making. And we definitely try to manage to one or the other. Most of our buyers are likely to be larger, you know, sponsors like other private equity groups or growth equity groups, right? So if it's a really high growth company growing 70, 80%, it's more likely that someone who is a path to IPO growth investor is going to be interested, someone like a TCV. Alternatively, if it's more of a profitable business and, you know, still good growth, it may be someone like an Insight or a Thoma Bravo, or a Providence Strategic Growth might be someone who goes and invests in our business. So that's how we kind of think about it. And those are probably the more likely people that we think as buyers. We also definitely have strategics in there, but we just don't want to optimize for a small group of potential buyers, given, you know, you never know what their timing is or what their appetite is. But definitely, I think that's a potential path as well.
Do you discuss this with the founders as well?
Yeah, absolutely. We try to be very, very open about every aspect. In fact, after we invest in the business, we'll show up and we'll walk through our investment committee memo and our underwriting thesis and the materials. And we try to be very transparent, because I think that's really where you get the best possible outcomes, is where you, again, have that true partnership with the management team and you're kind of trying to solve for each other's pain points, right? So for instance, we're really functioning as that outsourced corp dev team for our companies when we think about M&A. So we're doing everything from identifying, you know, the subcategory, mapping the players, engaging with them, negotiating the deals, diligencing them, and oftentimes really even helping with integration. So in that sense, we're an extension of the company. And this is a huge service that a lot of our portfolio companies see as valuable. And on the flip side, we're also not in there day to day. Look, our operating partners are heavily involved, but they're not employees of the portfolio companies. So we really need to make sure that, we see eye to eye with management, and we kind of have that same vision as to, what does success look like? What are we solving for, right? And we'll even go as far as to say, listen, if we hit this target of customers, that translates to X revenue, which translates to what we think is this potential exit band. And by the way, management team, this is what you would make in your rollover equity. This is what you make in profits interest, which we have in every one of our companies. And you're able to kind of really have that transparency, which I think, sometimes is not present in the industry.
Well, Vlad, thanks very much for your time in this interview, and best of luck to you and Nexa.
Yeah, it's been a pleasure. Look forward to listening to future podcasts.